Hey Gareth, how are you?
Alfie, I'm very well. How are you?
Good, thank you. How's your week been?
It's been good. I've missed you so far this week, though. We've not worked together this week yet, have we? So far, anyway. It's good to see
Yeah, absolutely. If you can hold on a few more days, I think we've got a meeting together
you.
next week. So just hang in there. Today, I've literally just ran in to make this call. Actually, I had a face-to-face meeting. Remember the last conversation we had where you were talking about face-to-face meetings?
Yes.
Actually, when I did
Yeah.
it, I had a good conversation, good meeting with the client, and she actually did mention the fact that it's good to have these face-to-face meetings now and again, which was good. It went really well.
Good. Oh, that's
So
to
yeah.
hear, yeah. I mean, I think most people sort of like a face-to-face. Sometimes it's not always possible to do it, as we said last time, is it? And sometimes, not even feasible to do it all the time, but sort of once a quarter or something, if you can, is great, isn't it?
Yeah, it makes all the difference. The conversation is different, and it feels better.
Yeah.
And we talked a lot about connection and all of that sort of stuff. You get it from that face-to-face meeting. So yeah, good, good. What about you? What has been happening with you this week?
So I've had a couple of client meetings. I've been talking to some new people, and hopefully those conversations will continue for additional work for me and additional clients. But like a lot of the agencies have been saying, it does feel quite when you're talking new business these days, talking new opportunities, does feel a lot slower than it used to do. People
Yep.
not making a decision quickly. It's not necessarily a no, but we talked about ghosting last time. Hopefully I've not been ghosted, but there's a couple of people I've been talking to
I hope not.
who I thought would say we've had situations in the past where people signed up on immediately working with us, haven't we? We said, send me the
Mm,
contract and where we go. But that does seem as if it's something that was happening in the past, but not so much at the moment. Let's hope that comes back for all of us, agencies,
yeah.
ourselves as consultants.
So, what are we talking about today? What has been on the menu, or what has been a big topic for you
Well,
this week?
not just this week, but I've something that's always a big topic for me, particularly when you and I are working together. It's something that people may or may not be familiar with, but it's this term revenue recognition. It's a finance
Mm,
term. So I thought we maybe this is your podcast, obviously, but I thought maybe we could turn the tables a little bit today, and I could jump into the sort of interviewer seat, as it were, and ask you some of the questions about revenue recognition. I think that's always a subject that people, if not want to, should know a bit more about if they're running an agency. How do you feel?
yeah, 100%. Good topic. And coincidentally, I said I just came from a meeting this afternoon. That did come
Yeah,
up. So you're right on the money, Gareth.
brilliant, brilliant. Always on the zeitgeist. No, this is interesting one. We've covered it many times, but I'll jump in with a few questions, if I may, on revenue recognition. And I think it'd be a good episode for people to, if they know about it, something to review. If they don't know about it, something to learn.
Absolutely. Yeah, good one. Good shout.
Happy with that? Yeah, good. So before we sort of dive headlong into it, I don't really agree with this, but I find that's revenue recognition is quite detailed. But a broader start before we start, the so many agency owners struggle with the number side, I think, don't they? They didn't, at the end of the day, most of them set up their businesses to stare at spreadsheets. They set up their agencies to create great creative work or build websites or whatever they might do. But I've seen in meetings we've had in individual clients, one to one clients or two to one, me and you working with them individually, and in our group sessions that we've had in our agency mastery program courses and things, people sort of saying things to me about or us about the finance stuff. Oh, that's not really my bag. But when you start to explain some of the terms and the concepts and get into a bit of the detail, I can see smiles start to come across people's faces. That sort of light dawns and people sort of really get into it. So, why do you think so many agencies do struggle with the numbers side?
I think it's one of those situations where people know what they know, and people who tend to start agency founders or agency owners usually aren't finance oriented. They're not commercially savvy. They're good at building websites or PR or whatever it is. But finance isn't something that comes naturally, right? Most people understand finance and numbers and commerciality either through training. So you're an accountant or you've had some training in finance, or through experience. And if you're an agency founder or an owner, more than likely you've either worked at a bigger agency, left and you started your own thing, or you kind of rose through the ranks, or you bought an agency like yourself, Gareth, but you weren't coming from the finance department. You were more, service delivery in some capacity. So that's probably the thing. So as founders, they've never had exposure to it. They've never been trained on it. I'll tell you, when I first started my career in finance, my very, very first job, when I was liaising with a lot of the MDs and leaders of the business, explaining these terms and things to them, because it was my first role, I just couldn't understand why they didn't understand what I was talking about. I was thinking, this is so straightforward. It's black and white. This is what it is. Da, 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 da. And they just didn't understand. So I used to get frustrated to start off with. And then later on, it clicked. I was like, the same way when they're talking to me about, web development or some terminologies in the agency space, I'm clueless, right? So everyone thinks differently to start off with. And then some people just either don't have the time or just so scared of the numbers to want to learn or get trained on it. So they just carry on. And, the smart ones get someone who either is a partner who understands numbers to kind of help them out, or they get consultants like us, Gareth,
Yeah,
right, to help them out as external people. But either ways, it is important and it's something they should be thinking about and doing.
totally. Yeah, no, that makes perfect sense. And I find we've seen it that often agency owners with agencies of a reasonable size, million plus revenue or whatever it might be, they know the basics of finance. But then we've come across people who we get to a subject like revenue recognition, and it's clearly something that they've never come across before. So, there's a need here, I guess, is what we're saying. There's a need here to upskill yourself on finance. Understanding the numbers hugely important as you're growing any business, but agencies is what we talk about. But then, particularly, even if you know the sort of basics and the terminology, to focus down now on revenue recognition, that does sound like an accountant's phrase. So, as a refresher for me and for everybody listening, revenue recognition, what's that all about?
Yeah, so you're not wrong. It is an accounting term, but what it is something that affects every business in some shape or form. So we're talking about agencies here. So I'll explain it in the context of an agency. So when you talk about revenue recognition, what you're talking about is you deliver a service as an agency. How do you, I don't want to use the same term, recognize, how do you take the fee that you're being paid into your books? How do you record, I'll use that term, how do you record the fee that you're being paid on your books? Let's take a business that bills hourly. If you're doing an hourly billing, you're being paid by the hour. You should record the revenue by the hour as you get paid. So I do X amount of work in X amount of hours. What is the fee for that period? I'll record that on my books. If it is a fixed fee, you can use other recognition methods. You could either base it on time or use some sort of milestone, get approvals from client, and then record it that way. If it is a value price, similar kind of thing. But the principle behind revenue recognition based on accounting standards, so you've got accounting bodies like IFRS and GAAP, they dictate how accounting practices should be treated. And with revenue recognition, the principle is that work should be recognized or revenue should be recognized or recorded as the work is being delivered. So, what that means is I can't take any money from a client unless I've delivered the work. I can't show it on my books until I've delivered the work. That's the simple, simplistic way in a nutshell of describing it. And the reason for that is if you don't do it this way, then it is very easy to manipulate the numbers because if you picture in a financial year, let's say your agency isn't doing too well, right? And you want to fool the public or fool HMRC or whoever without that rule saying recognize the revenue based on the work. What you could do is you could just ring up a client and say, oh, client, can I pre-bill you 90% of the work or 100% of the work this year, even though we're going to do the work next year? And if they say yes, then when you bill them, you record that billing this year. Meanwhile, you're not delivering the work. So what that is you're falsifying your books because you're making your revenue and your profitability look bigger than it is. So that's why that rule was put in place to say the work has to follow, sorry, the revenue has to follow the work. That way, everything is true to what is delivered, right? And everybody's on the same page. So if you think back, Gareth, that if you remember Enron and all of that problem that arose from fraud and poor accounting,
Yeah.
this is one of the things. They were misrepresenting their revenue in different periods to suit their needs. So the bodies have just said, do it this way. Recognize revenue when you get the work done. So that's the basis for revenue recognition.
Cool, cool. So that makes sense. That's a good summary, of course, Alfie. But I could say if I was an agency now, try and put myself in an agency owner's shoes, because this sounds like the right thing to do, the legal thing to do, but that's sort of my accountant's problem, isn't it? Why don't I just leave it to, do I need to get involved in that as an agency owner? Just leave it to the accountants. They can sort that out.
And that's a good one, because today, one of the things I talked about with this client, they said the accountant wasn't speaking to them about revenue recognition. So he was doing it on the. So when we talk about revenue recognition, it will marry up with your costs, in a sense, your cost of sale, because cost of sale have got to do with the project. So without going into too much accounting
Yeah.
jargon, the revenue, when it's recognized, will be in line with the cost of sale. So this particular agency, the accountant was saying to them, oh, I see there's a big pot of money here. What do you want me to do with it? And my client used to go back to their accountant and just say, well, we don't know what to do with it. You're the accountant. You tell us what to do with it. But he didn't explain it to them properly. So what this accountant was doing was he was just turning around and just doing whatever he thought was right in terms of revenue recognition. But to your point, the founder or the owner needs to understand it, because they need to give the feedback to the accountant about what he should recognize, because he's not going to know. He's not in the business. In most cases, we're talking about external accountants. They don't know what you've delivered, when you've delivered, and how much that should be. You need to know it. So for you to be able to communicate that to your accountant, you need to understand what it is. And what you really, if I have to distill it down to a single thing you need to understand, is just understand what is being delivered for how much, and then communicate that to him, and then he can do the rest. Because then we go into territories of deferrals and accruals, and again, that's another a conversation for another podcast.
You.
But just know, I saved you there, Gareth. Just know what is being done, when, and for how much, and just tell your accountants that they should be able to do the rest.
And that makes sense. Yeah, totally. When I've come across situations myself, I'm sure we have when working together as well. Is it fair to say that this is important stuff, but is it fair to say that it's more important potentially for project-based agencies than retainer-based agencies? Is that fair or not right?
That is a very fair statement to make, because you're absolutely right. In terms of the revenue, retainers, if we're talking about retainers in the true sense of the word, because these days people call all sorts of things
Yeah,
retainers. People will say, oh, we've got this pot of money
yeah,
and we spend it as we go along. That's a retainer. That's not a retainer.
yeah,
A retainer is a set amount every
mm,
month to
yeah,
deliver the same service every month. That's a
yeah,
retainer. So if that's the case, then yes, technically speaking, revenue recognition isn't as important, because you get the same amount of money every month for the same service every month. So as far as the HMRC or the accounting bodies are concerned, the work is predetermined. You know what it is, you know how much the fee is every month. So you just take that. So if you're purely retainer based as an agency, yeah, you don't need to worry too much. But if there's a mixture, like the client I was talking to today, majority of their work is retainers, lucky them. And then they've got a percentage of projects as well. So with those projects, they still need to apply that revenue recognition. And I don't know if you remember this, Gareth. You and I worked on a client a while back, and they were recognizing revenue based on billing.
Yes.
And it just meant that at the year end, in some cases, the revenue had a tendency to be higher or lower than what they had actually done. I won't say any names, but I'm sure you remember this client, Gareth. So it is important to have revenue recognition. So when you're filing your accounts, you're only showing the right amount of revenue for that period.
Totally, yeah. I'm glad you've got. We're both on the same wavelength because I've got that client in mind, and they're a good business, but we wouldn't be right to mention the name because that was a bit of a journey and still is for them to get this new way of recognizing revenue in place. But yeah, I get that now, and I think some of the agency owners we work with, agencies we work with, as you say, whether it's retainer or whatever it's called, but where they're getting a fee of 5 grand, just to pick a number, every month for 5 grand's worth of work. An invoice goes in for 5 grand. They do 5 grand's worth of work, and in that month, and they receive 5 grand. That's sort of okay, isn't it? But it's where these bigger web builds, where it's spread over a number of months, or particularly,
Mhm.
as you mentioned there, Alfie, and I know quite a number of them. These pots of money that appear from clients, agencies often have to deal with these pots where some money is lodged with them, often at the end of the client's financial year, so that they can call it off, which is a great thing. Nobody's going to turn that down, or few people would turn that down because it's money in, isn't it? And it's the guarantee that the work is going to be forthcoming. So, but lodging those, but then recognizing when that work is done and in what month in the future and how it's sort of called off, if you like, is really crucial, isn't it?
It is. It is. So that point you said there, that's actually a tactic or suggestion I make to people to remind clients, at the end of the financial year, or as it comes to the end of the financial year, which tends to be the calendar year, to ask clients if they can pre-bill any work, if there's any work that, because most clients are looking to spend their budgets at the end of the financial year anyways. So what that will do is it won't help your financial position this year, but it'll secure the cash for next
Yeah,
year because they pre-build. So this is where, unfortunately, I'm going to have to go into the technical aspects of accruals and deferrals. But this is where if you pre-bill that amount, so you speak to a client at the end of the year, right, and you say to the client, "Can we pre-bill you for X, Y, Z?" Client says yes. Great for your cash position. You've got the money in the bank and some level of commitment from the client against next year. But on your books, to be compliant with revenue recognition rules, you have to defer that revenue that you've billed. So if you pre-build 100% of the work, you've only done 10% of it this financial year, it means 90% of that revenue needs to be deferred to the next financial year. And a deferral is just simply move it from this year, put it on your balance sheet, and then recognize it next year when you do the work. So that's a deferral. And the flip side of a deferral is an accrual, which means if, for example, you've done the work and for some reason this financial year you haven't billed the client for the work, so you haven't physically received the money, it means that you accrue the revenue. So you will show it on your books, even though there's no physical payment received or billing done. You show it on your book. It's called an accrual. And then next year, when you actually bill the client, it reverses out that accrual and then you're back to where you should be. So again, it's all about representation and accurate representation of revenue in the correct financial period. That's what it's about.
totally. This agency that we're both thinking of through our telepathy, they were good, again, but they are a good business and a large business, 2 million revenue, wasn't it? At least.
Yeah.
And but big web builds, and this was a bit of a revelation and so a significant change, introducing revenue recognition to these guys, wasn't it? It's not something they'd be particularly, certainly running the business they'd done. Perhaps their accountant would have done it at the end of the financial year and sort of when doing the books, but they weren't doing it. So, as I remember it, the founder of that business, great guy, particularly focused on sales, of course, hence his success as an agency. So he was every year wanted to see an increase in sales, but his numbers every year weren't delivered work, were they? They were actual sales, committed spend from somebody, but the work had not been done and completely boxed off in that financial year. It carried over. The accountant sorted it in terms of the books, but as I remember, the founder didn't truly sort of grasp this. So when we
Mm.
introduced this concept of recognizing revenue on a sort of monthly basis in the sort of management accounts, it came as quite a shock because it skewed his figures, didn't it, quite considerably, and
Yeah,
therefore meant
yeah,
that actually in the financial year that we introduced this, he couldn't achieve his growth that he wanted because he'd still done the same effort, still done the same sales numbers underneath, but actually because of we were recognizing the revenue in that year, and rightly so, we still maintain. But it was a bit of a shock. It was a bit of a hard thing to get his head round. I'm telling you that, you know it, but I don't know whether you can explain that any better than, well, yeah, I'm sure you can explain that better than I can so that people can understand what that shock might have been and why it occurred.
yeah. I think that's a good one there because that's the position a lot of owners and leaders, founders are in. Because if you're looking at your P&L and all you're seeing is amounts invoiced,
Yeah,
it gives you that false sense of security because you're seeing big sums hit your books. And if there's no revenue recognition or awareness of revenue recognition, then at the end, when it gets to the end of the year and the accountant turns around and says, oh, how much of this have you actually worked versus just billed for, it's a bit of a shock because all through that period, through the whole year, they've probably been planning and budgeting and hiring on the basis of those big chunky numbers just hitting their books. And then when someone turns around and says, "Oh, you can't take all this money this year," it's a shocker. And most of them just can't handle it because they're like, "No, no, we need it to be this number." But there's a difference between what you need and what it really is. And if you want to be compliant and legally compliant, you unfortunately, well, you have to do that. You have to make sure that your revenues are reflected. But actually, one other thing that you and I talked about at the time when we were talking about this whole situation with this client was there is an actual benefit to the agency to doing this. So it's not all about compliance, it's not all about HMRC or what they want to see on there, but there is an actual benefit. And the benefit is you're able to make better decisions if you're revenue recognizing because if you picture your resourcing as an example, the way you resource your people, your staff is based on how the work is being delivered. Now, if the money that's hitting your books is higher than that, then again, there's that false sense of security or the illusion that you're doing better than you really are. And really, that, and we've seen this time and time and again, Gareth, with some of our clients, when we look at their books and if you go back a few years, you see at some point there was this massive rush to hire people. A lot of it is based on, oh, we invoiced this much and blah, blah, blah. But the reality is, yeah, you invoiced it, but it wasn't yours to recognize. You hadn't done the work. And in many cases, you didn't need the people at that point in time because the work wasn't due at the time when the money hit, if that makes sense. So there is an importance to knowing it beyond just being compliant. It does operationally, it does help the business because you can track your forecasting. If your forecasting is based on when you actually do the work, i.e., when you recognize revenue, then you're able to plan better, you're able to resource better, you're able to hire a lot better, make those decisions rather than just a knee jerk reaction of we've suddenly got this amount of money sitting in the bank. Meanwhile, it's a pre bill. and we need to hire, we need to hire, we need to hire. When the reality is the work isn't due, or you're not going to start working on it until a future date. And I think this client eventually started to see the benefits of it from that point of view. So yeah, that's something agency owners and founders need to bear in mind.
Totally, yeah. And actually, as an ex-agency owner, that's the part of all this that is the bit that really interests me. Of course, I'm interested in the compliance and all the stuff that we need to do from an accounting standards perspective. Of course, I am, that needs to happen. But that you just explained there, that's the bit that really well interests us both, I'm sure, because with that client that we had, you saw a situation whereby they had been not recognizing the revenue, but recording the sales and invoicing in the year. But then, so let's say that the fact, as I recall it, that it was a great case study because as I recall it, the financial year was January to December, let's say for the sake of argument, and had really done some great numbers by the end of December. Again, a record year, everyone was celebrating, but then started the work, not completed all the work for that year, but invoiced it all. But then the following year, they were playing catch up, so
Yeah.
they were still doing some of the work that they'd already invoiced the previous year, and then winning more work, but then struggling to understand why their dev teams were saying, "Hang on a minute, we can't hit those deadlines, and we're absolutely mad busy." And you've just won another project, but we can't start that for another couple of months. The management team of that business were sort of perplexed, weren't they? They were saying, what the hell's happening here? Because we
Hmm.
just had a record year, good start to this year, looking good, won a few more projects, but our dev team are mad busy, crazy, and saying that they can't meet the deadlines. And the reason was the dev guys, in fact, were catching up, weren't they? They were still doing the work that the management team had recognised in the previous year and almost drawn a line under, recognised it and sort of said, well, that's done now. We've invoiced that. That was a great year. This is a new year. But the actual machine of the operations of the business were still delivering it, weren't they? Which was causing chaos, wasn't it? And real growth pains and real sort of people, not financial problems, but people problems. It sort of translates into that thing you mentioned there just now about a recruitment drive. So, well, if the devs are busy, then we get some more devs in. But then when it goes a little bit quieter later on in the year, when if miraculously everybody does catch up to a degree, then this bigger team is a bigger overhead, and maybe there isn't the work for those people to do.
That's true. When you peel the layers, when you're looking at why teams are burnt out or stressed out, or you look at a forecast and the forecast doesn't match what people are saying about, how burnt out they are or overutilized. Sometimes this does play a role, exactly what you said, Gareth, playing catch up, right? So the work you're doing doesn't have it should have revenue associated to it, but you've already taken it in the previous financial year. Therefore, you've got all of the staff costs, but none of the revenue. So that will impact your staff costs to gross profit. It'll impact your profitability. It can impact your client profitability because again, you'll have all the costs going against projects, but none of the revenue. So that client might look unprofitable. But if you had just recorded it properly, it could have been profitable. I'm curious to know, Gareth, when you ran your agency, what method of recognition were you using back then? And did you understand the concept at the time?
Um, we were recognizing revenue. We were predominantly a creative agency. Projects was our world. We had, again, people use the term retainer in a very loose way. We had monthly fees from clients, from some clients, so it wasn't just project here, project there. But nevertheless, there was a lot of project-based work, and it didn't always just happen in the month. It spanned several months. Some of them were big campaigns, advertising campaigns that took several months to go from start to fruition. So we were recognizing revenue. In the spirit of full disclosure, did I understand it as the agency owner? No, I didn't. Uh, but I was lucky enough to have,
I love the honesty, Gareth.
yeah, which is yeah, true. My honesty is my weakness, but I'm too honest. But that is the case. And I
Hmm.
can say that, but I was in a fortunate position because when I bought my business, I bought it well, two other partners, and one of them was a finance director, a great guy. So he
Oh,
sort of did the finance. Then he left, and then we then recruited. You know, we were of a size to recruit not as a shareholder, but as a senior finance person, or a number of them following that. That then they sort of looked after not just the accounting policies and working with the accountants, but they presented these numbers to us in monthly meetings in a way that perhaps revenue recognition wasn't the term that was sort of thrown a spotlight on, but the numbers made sense. And we could make, and people that you and I work with now, that the key for me is, again, it's not about necessarily the most important bit for me is certainly month by month, not the accountancy aspect. It's the making strategic decisions, isn't it? From these numbers, it's
yeah.
making a decision on when to hire, when to push for more growth, when to accept projects that perhaps maybe you think, well, you wouldn't normally accept, but you need to, you can because your capacity is a bit low.
Mm,
And you can't get a true handle on those sort of decisions, particularly hiring, when the numbers are all skewed and you've got these sort of pots of money going on or sort of hangover projects from stuff you've already built. You can't make those decisions properly, can you, if you don't have a true reflection of what's going on? And I think that's why revenue recognition is really important. So it's something that after my agency life, I came to understand more, but I needed to, because until we met, I didn't have a wingman or a wing person to explain it to me. But some people,
yeah.
that mine was a big agency. Many people that we work with are a reasonable size, but they're either they have a finance manager or a bookkeeper, or a more junior finance person, but not a finance director or a CFO or whatever. So often the bookkeepers are just doing what the bookkeepers do and doing a good job of it, but they're not interpreting the numbers and helping make decisions from them, which is so crucial, isn't it?
Yeah, there's a good point you make there on just that, on the bookkeeper and finance manager thing, because the reality is many bookkeepers don't understand the concept of revenue recognition or how to deal with revenue recognition as far as posting the transactions. And actually, I've got a client who has a bookkeeper, and when we first started working together, we tried or I tried my best to get them to do revenue recognition, just because a lot of the challenges we've talked about today, they had them in terms of the teams just overworking and all of this stuff, dealing with old revenue. And the bookkeeper was just not having it and just very reluctant to change, or just because they just didn't understand the concept of what to do with it. So many times, just because you have a bookkeeper or a finance manager, don't just assume that they understand it and they're doing it,
Yeah,
right? So make sure you're speaking to your year-end accountant, as an example, and ask them what they need and if this is being done, and if they need anything from you, because the bookkeeper or finance manager might not be the right person to deal with this sort of stuff. And if it is something, if you're predominantly project based as an agency, then it is important to get this done. So just don't assume as an agency owner or founder that just because you got a bookkeeper or a finance man, they understand this stuff. Sometimes they don't. So
yeah,
yeah.
no, totally. I think that's fair. Just to add to that, I don't know whether you agree with this, but I've seen, I think, many times over the years, you give me your view, but in recent times where agency owners, businesses I've been working with, have this belief that their accountant is regularly reviewing their business and helping and keeping a sort of watchful eye over what's going on. And this is not a negative against accountants, I promise. But the reality is, I think people have in running businesses have or agencies have that view that their accountant is somehow sort of sitting above all this and regularly sort of looking at the books, and that just isn't the case, isn't it? Unless people are paying accountants to do that, to perform that service and meeting with them monthly, but many people aren't, and it's only till the end of the year that the accountants are really looking, because they're not being paid a fee for doing that, and they've got many other clients to work with. So do you see that as well? Am I making that up, or?
Not at all. And again, I think you and great minds think alike, because what you're saying now, again, was a conversation I had this afternoon with a client. And so this client I'm talking about, I've only just signed them on as a client. And one of the things, so they've changed accountants. And the new accountant now, I had to get on a call to brief him on, what we need to do and this and that. So when I did an audit of their numbers, previous years, there were certain things I had to ask, and I was like, how did it get like this? And they said, well, the accountants never told them, advised them. But what people don't realize, or what agency founders don't realize, is the term accountant is not a general, oh, you can do everything and anything. Same way, with doctors, you've got a heart surgeon and you've got a brain surgeon and you've got a pediatrician and all sorts of things. Accountants focus on certain things. You got year-end accountants that are just there to do your year-end work. So they'll file your accounts, they'll post whatever needs posting, reconciliation, so on and so forth. You've got the bookkeepers that do that on a day-to-day basis, week-to-week basis. And then you got commercial or management accountants or consultants that will actually give you advice on what to do. Usually these ones, like myself, have got the experience, we've got the training and qualification, but we've got the years and years of experience in agencies. So the advice you're getting is not a generic, oh, numbers are this, numbers are that, profit is the. It is specific to agency work. So when people are complaining about how their accountants aren't giving them advice or aren't feeding back, they don't understand what they're paying for. In many cases, that's not what you're paying for. You're paying a year-end accountant, and he's just going to do your year-end books and probably give you general advice on, maybe taxes and so on and so forth. But he's not there to advise you on, okay, this is not going according to plan. Here's what you could do. Here's how you could pivot. That sort of stuff is different. So a lot of people do get that mixed up, Gareth, in terms of just assuming the roles and responsibility of their year-end accountant is to give them commercial advice. That's not it.
True, totally. So, as an action step for people listening, I guess, would you sort of say that if, well, people are listening to this and thinking revenue recognition, either I've heard of it or, like Gareth, I haven't been ignoring it when I'm running my agency, or I'm not sure, a step could be to have a meeting with the accountant, couldn't it, to get them to explain further what they're and see whether they understand it, I guess, but also how it applies to your business, the agency owner's business, and is it something that they need to focus down on a bit more, and would it be valuable to do it again? Well, not purely, I would say from a asking those questions from a helping you to run the business point of view, not helping the accountant to do the year end. Hopefully they're okay at doing that. Would you say that was a good step to do?
Spot on. Literally, the only thing I'll add to that is, first of all, just make sure that they have been doing it in the first place. So make
Yeah,
sure that, because accountants are concerned about the year end. Your year end accountants are concerned about the year end. So to them, as long as at the end of the year, revenue recognition is done properly, that's all they care about. Where if you've got a finance manager or you've got an advisor, they'd be more concerned about revenue recognition on a monthly basis, because that impacts your operations
yeah,
in terms of what I explained, resourcing, forecasting, all of that sort of stuff, and decision making.
yeah.
So first of all, ask the accountant, have you been doing this? How have you been doing it? Because if you're not sure about how they've been doing it, you need to make sure that they've been doing it correctly, i.e., they've been getting the right information from, if not you, someone in your team about how much they should be recognizing in whatever period it is. And then after that, everything you've said.
Yeah, great. But one of the things that you've just been talking there, that we talked about revenue recognition potentially helping with recruitment, with capacity planning, but it's also a great tool for looking at individual client profitability, isn't it? Within an agency,
Mhm.
which is often an issue I find. The agency founder knows what their overall profitability is, generally for good or for bad sometimes, but few people have a true handle on individual client profitability, and even when they look into it, it's quite hard, quite opaque to sort of try to get that information, because again, they've not been recognizing the revenue in the right places for individual clients.
Yeah, that is correct, because Again, to the example I gave earlier of pre-billing, if you've got a client that's consistently asking you to pre-bill them,
Yeah.
there and you're not doing revenue recognition, that client will look super profitable. You run a staff cost to gross profit on that client, amazing, because it looks like you're only using a small amount of cost, so amount of resource to generate all this money. But the reality is not all that money belongs to whatever period you're looking at, because you're not revenue recognizing, you're just billing and recognizing on invoicing, on billing. So 100%. If you're looking at client profitability and the revenue recognition isn't right or applicable to the period you're looking at, it can make it look very profitable, or the opposite, it can make it look unprofitable, because it could be a case where you haven't billed the client, but you've been doing all of this work. So therefore, you're looking at it thinking, "Oh, this is not a client, profitable client, because all it is just costs and very minimal revenue." But the reality is, you could have accrued that revenue and shown a lot more revenue because you've actually done the work. So it does play into, I think, just about every operational activity in an agency. Revenue recognition plays a role. If you're talking about visibility and accuracy of data, revenue recognition plays a huge part in this.
Yeah, totally, totally. And just
Yeah.
I was thinking, I totally agree with that. Operationally, it's hugely important, but there's other aspects of this as well, I guess, isn't there? In terms of if and when you look to sell your business, the agency, the treatment of revenue recognition can have a big play a big part, can't it, in valuations and how a buyer might look at your agency. I don't know whether we've got time for you just to sort of build a little bit on that.
Yeah, yeah, definitely. So that would be one of the first questions someone who's doing evaluation would ask is, what is the method of recognition in this business, and trying to understand the revenue. Because as everyone knows, most agencies, when they're being sold, are on the basis of EBITDA, which we can talk about another time, Gareth. But in a nutshell, is the profitability, and then you add a multiple to that, and then get to a rough valuation figure. Now, if the revenue recognition is off, then it throws off your EBITDA number. And then that could either get you to think you deserve a bigger multiple, or it could skew the numbers and you're looking at a smaller valuation, because the reality is you're not showing enough revenue in that period.
Yeah.
And therefore, your EBITDA or your profit is lower than it should be. And that affects your sale price, So getting it right, good point, even affects sales and transactions at any point.
Yeah, it's classic territory that for me, where again, like our friend we mentioned earlier, successful business, you can show a track record of growth and profitability across year after year. But then, if and when somebody comes along and wants to buy you, they can make an initial offer or heads of terms based on those numbers. But when it's prime chipping down territory, this, isn't it? Where once they start to do due diligence, the buyer, and they understand that there's nothing wrong here. There's not skeletons or things that people have been doing illegally, but the numbers are skewed, let's say, because they're not been recognising revenue properly. It's great fuel to start chipping down offers, isn't it, and prices, and start you're actually making less money than what we thought because you've not done all the work yet. You've reported the profit, but you've not done all the. You've shown us you're making the profit, but you've not actually delivered some of the work. So
Yeah. I think one thing you don't want to be doing at that point is just, you know, stuttering when they ask you that question about revenue recognition and not knowing what they mean, even by revenue recognition.
yeah,
So, back to your original point of owners and founders understanding it is key. And then hopefully at the end of this, listening to us talk about it now, hopefully they've got enough of an understanding at least to ask the right questions from their accountants, or do some more research to understand properly what revenue recognition is and how it affects their business and so on and so forth, because it is really, really important.
well, Alfie, I really enjoyed being in the one asking the tough finance questions. It's normally you is asking the tough finance questions of other people, so I quite enjoyed that. Is there anything I missed? Anything you were expecting to be grilled on that I forgot something about or didn't know.
No, no, I think you did a great job, Gareth. If you ever consider changing careers and becoming an accountant, I think you've got a spot. You got that. It won't be a bad idea at all.
I,
You did a great job.
I,
So yeah.
thank you. I don't need to. I've got you though. I've now worked with you, so I can just with that. Everything I've learned off the master. So no, it's very kind of you. Thank you. That was a good session. I think.
Yeah,
Well, hopefully people have got a lot of value out of that. I'm sure they will have. And if nothing else, it throws a spotlight on, yeah, as we said at the start, what is a sort of financial technical term, but it's something as a concept that particularly as you grow, and particularly if you're in project based, an agency that works in a sort of some sort of project based way or tiered payments or has work that transcends more than 1 month, in terms of campaigns or website builds or whatever it might be, something really important. It's not, again, not just for me for an accounting standards point of view and satisfying that, which is hugely important, of course, vital, but also the management of the agency day to day. Getting a true handle on those numbers is really important. Making decisions so you don't hire too many people or you don't hire enough in advance, or that's really useful information, isn't it, in terms of making decisions.
it is. It is. I've enjoyed this, Gareth. Thank you, and thanks for not grilling me too hard. So
Maybe next week,
yeah,
next time, yeah, I might pick another finance topic and grill you a bit harder
yeah. No, go ahead. Go ahead. I think I've been doing this long
for
enough
it.
to be able to answer just about any question, Gareth. So I think I'll be fine.
I'm sure you will. I've seen you in action. I'm very, very familiar with that. Thanks, Alfie. That was really good. I enjoyed it.
Yeah, likewise. Thank you,
See
Gareth.
you
Catch you next time.
next time. See you soon. Bye.
Yeah, nice one.